All right, everybody. Turn myself on here. Share my screen. Boom. Here we go. Chapter 12, investing in stocks and bonds. Let me see. I can do this much. Yeah, much better. Good. Investing in stocks and bonds, chapter 12. We're almost done. 12, 13, 14, 15. So after this, only 3 more. And getting pretty close to the end here. So hopefully you've been enjoying this class. Like I said, it's much better in person, but we're doing the best we can to do this with all these COVID restrictions. So some of this is going to be repetitive from chapter 11, but yeah, so let's get into it. We talked about this before. Risk, just investing. There is risk associated with investing. It's kind of like more popular form of gambling, I guess you could say. I guess you're probably looking at what's behind me. Those pictures. My wife just changed. I'm at home actually today instead of in a classroom. She just changed these frames. I don't know why. They look like there's like plants in them or something. She says they're going to change. She's going to put pictures of our pictures of travels, places we've gone to. So maybe by the next time I do one, there'll be some pictures in there. But anyway, risk, basically it's just the types of risk associated with investing. Like there's business risk, financial risk, market risks, purchasing power risk, interest rate, liquidity. There's all these kinds of risk associated with investing. Like if you're investing in a business, there's a risk. If you're investing in financial market, there's a risk. If you're risking, that's going to potentially minimize your purchasing power because that capital, that money is going to be tied up in something else. There's risk, because if you might be moving money from one category to the next, which could potentially affect your interest rates because you would have, who knows, you might be taking on more debt in a risk, which could affect interest rates. Could affect your liquidity, like how much cash you have access to. So there's all kinds of risk associated with investing. Here's the big concept for chapter 12. We actually went over this in chapter 11 when I pulled up that rebalancing, the asset allocation, the diversification, and rebalancing. We kind of went over this in chapter 11. It was when I pulled up just kind of a Word doc and just went over the portfolios. When I wrote the portfolios, I broke them down with Candy, and then I broke them down into kind of like what a portfolio of Candy would look like, and then from there, what a portfolio of stocks would look like. And then the rebalancing is a very important concept of, over time, when you're younger, you should probably have more risky type of investments, more in stock, less in bonds, and then in some other categories as well. But and then you kind of get more conservative as you go, with more monies in bonds and less in stock. So that's basically kind of I kind of teed it up for this asset allocation. That's just basically your decision on how you can divide your investments along different asset classes, which can include stocks, bonds, cash, and real estate. So basically, like I said, like for the stocks, for your portfolio, you would have invested in different type of asset classifications. You can do the same with bonds. You can look into bonds, and I'll get into different types of bonds a little bit later, but you can just have your money into different types of bonds because you want to be diversified. You don't want to have everything into one category, everything into one type of investment, because you are just basically your exposure, you have more exposure for, or more opportunities for there to be a problem because if something goes wrong with one investment, like if somebody says, "Oh yeah, I got a great deal, a great investment," or invested heavily with a company. You're in a company, you get stock options. That's all your investment is, or the stock options for that company. That can be very dangerous because if something happens to the company goes belly up. Usually when we're in person, maybe like this in a 16-week class, I'll show you the movie Smartest Guys in the Room. It's about Enron and all these Enron was a great company. This company had great potential and was performing very, very, very well. It was an energy company, but it was just a con. It was a scam, and all these people, these employees had a ton of money, all their retirement tied up in Enron. And then when the company went belly up, they had nothing. They had no retirement. So their nest egg was just destroyed. That's why you need to reallocate and diversify your assets. And even like within real estate, like within cash, different like money market accounts, CDs, that kind of stuff, different options for cash, and not different types of cash. I mean, there's only like so many types of cash. But when I say cash, like, your CDs, your money market type accounts, and then real estate. And real estate, there's a ton of different asset classifications in real estate to invest in. Single family homes, could be retail, could be commercial. There could be what else? Apartments. Could just be in raw land as well. This is kind of same thing. Like I just talked about diversification. Your portfolio should be diversified among and within. That's very important there. So it should be diversified among different classes and within different classes. So let's say among, let's say real estate, and then within real estate, there are all those different classes that I just mentioned. How many categories within stocks? A ton of different categories within stocks. How many categories within bonds? A lot. And then different categories within real estate and different categories within cash. So you want to make sure your money's spread out so that you're not exposed to as much risk. Rebalancing, I kind of talked about this just a little bit earlier. It says over time, change the mix of your investments so that as you get older, you're into more conservative investments. Instead, because when you're younger, that's your time to be a little bit more risky. And that's your time to really grow. Your money should hopefully really grow, and you should be risky, not 100% risky. You could be like, even within a classification, you say, I want to have stuff invest in something that's highly risky, like maybe 60% of 70% of my portfolio will be risky, and then within a category, and then the rest will be very conservative. And we'll get into what's that kind of more conservative stocks up here in a second. Risk-free rate of return. This is basically the rate of return on which government securities such as treasury bills, it's considered free from default risk. So those are very, very, very safe, stable investment opportunities. Lower yields, lower payouts, but very, very, very safe. Required rate of return. That's like that's kind of like what you would want to get, and be realistic. Basically, the definition is the minimum rate of return an investor feels should be earned in compensation for the amount of risk consumed. Be realistic with what you want. Don't sit there and say, I want to get 60% return. That's just not real. And for some of the stuff, it's not realistic. Are there opportunities in life when you can invest in something and you get paid 60%, 100%, 300%, all these crazy, like you hear about these stories with the first people in at Microsoft, they're a Microsoft employee, or first, are early adopters to, certain companies. Those things can happen. For the most part, you have to be very realistic with what your, what you want to get. If you can get 10% a year, that's great as it compounds. So you know what I'll do? Hold on. I'll do that a little bit later. Let me see if I can figure that. I'll do that. I'll do the rule of 7 here in a little bit. Actually, let me see if I can do it right now. I have to pull up an Excel spreadsheet and show you how this works. Sorry, I wasn't planning on doing this, but I just wing it sometimes. All right, so let's get me onto here. Let me share my screen again. Sorry, deal with me and technology. It's not a good fit. Okay, let's do this. Is called like the 7-year rule. We talked about it before, right? Right. Let's say you initially invest $1,000, right? Actually, I'm going to do 1,000 up here. So after, you'll see what happens. That's your initial investment. Boom. And put here, invest. This will make a little bit more sense as I do it, right? So, and let's say your return is going to be 10%. Right? Okay, so let's say after your first year, you're getting 10%. We're going to take this times by 1.1. By the way, here's a great little tip. Whenever you want to find out, you want to let's say you're going to buy some things at the store. It's like you go buy something $29.99, something that's $3.49, and something that's $5.99, and you want to find out, okay, what's the total after tax, right? Sometimes you go like this. You go, oh, like this plus that. I'm sorry, I'm gonna do this kind of, and then you're gonna say, okay, so that's your subtotal, right? And then you're gonna try to find out the amount with tax. Most people, let's say the rate, what's the tax rate? 8% or something like that, times 0.085. That would be your tax. That's how much you're paying in tax, right? And then the total for that would be, those two. It'll be $42.82. What I say tax rate's 8.5%. Better way to do it is to do this. Ready? Okay, so let's say you have that same scenario. What you want to do is take that. Actually, you're gonna go one. Sorry. Right. Better way to do this is do that times 1.085. That's it right there. So what I do, I times the subtotal, which you're gonna see up here. I times it by 1.085. I skip the step. So what you're really doing is you're multiplying it, you're multiplying it by itself, and then you're adding on 8.5%. So that's how you do it. All right, so anyway, let's say you're gonna get 10% return. You take your $1,000 after year one, you have $1,100. After year two, times by 1.1, you'll have $1,200. Make sure we got all the nice commas and everything in here. All right. After year three, you have $1,300. After year four, $1,400. Year five, $1,600. This is just growing at 10% a year. That's what this return is at. And then here, do that 19. So in 7 years, basically you have, in a sense, doubled your money with getting 10% return. And you've done nothing. You got a 10% return, and you took this $1,000 and you turn it into almost double that. Okay. Now, let's take this scenario. Let's add 2 zeros to it, right? Look at that numbers. Look at how those. Look at where that went up, and also take into consideration, you have this money that's growing 10% every year. And a big thing that you're going to realize: what if I wanted to put in more money? Sure, you can put in more money. This is without doing anything. It grew by at a 10% rate of return. It grew almost double in 7 years. That's like the rule of 7, which is wild, which is crazy. You think about it, and that's without putting in any more money. So know that that's the power of compounding interest. So that's a good little tip there. Stop sharing. Let me go back to the slides. Oh shoot, I gotta go back to this, right? Share the screen. Let's go back to here. Perfect. Hopefully we can see this again. I like slideshow, looks better. Okay, good. Okay. Oh shoot, I got to start over. What? Rebalancing, boom. Required rate of return. That's just how much you want to get. See what your money grew to, just getting 10%. It's pretty reasonable, pretty accurate of what you can get traditionally in the stock market. I mean, that's very, very, very realistic. And once again, the stock market is not an indication of how the economy is doing. That's a basic indication of how corporations are doing and how investors are doing. It's just kind of weird that in times when our economy's falling apart and you got 20% unemployment or 30% there for a while when COVID hit, but the stock market was still just doing great. That's really is an indication that the stock market really isn't a leading indicator of the economy, but that is the most accepted way to grow your money. And I don't think that's going away ever. So because with how much money and how much investment, not just of time, but just of resources that going into to make sure that stock market is stable by the rules in place of protecting banks and financial institutions. So that I don't think that will ever go away. So what are residual owners? You would be a residual owner, the shareholders of a company. The shareholders, they are entitled to dividend income and a share of the company's profits only after all the firm's obligations have been met. And they want to make sure, companies want to make sure that shareholders are happy and they're profitable, because once people start taking money out of the company, then that's and start selling their stock, that's a bad indication. That's a bad sign for the strength of a company. And remember, I don't know if I mentioned this earlier in a lecture, that when you're talking about publicly traded companies you can buy stock in, they have a legal obligation not to the end user. They have a legal obligation not to serve society the best way that they can. They have a legal obligation to increase and protect shareholder value. That means be profitable for the shareholders. So if their focus is to be profitable for shareholders, they're going to make sure that those stock prices stay as high as they possibly can. And living in that world, if you're on the C-suite, meaning like the chief, I mean, we ever hear somebody say C-suite, that means like the CEO, the CFO, the COO, the chief operating officer, the chief financial officer, the chief executive officer. I said that first, actually. That they have to live a very strange life, because they have every quarter, they have their quarterly earnings to think about. So every quarter, so every 3 months, every 12 weeks, they have to make sure that they can hit these quarterly earnings targets. So you have to basically imagine, like, if you're an athlete, if you're a runner, and are you good at sprinting, meaning, 100, 200 yards or 200 meters at a time? Or are you good at long distance, meaning, 1,500 meters, 3,000, half marathon. These companies, in a sense, they have to be nimble enough to be good at both, or do well enough for both. They have to make sure that they can sprint to their quarterly, quarterly little sessions, but then also be good long distance runners in maintaining and protecting the long-term viability of a company. So to be profitable, boom, almost like every quarter, but then also have that foresight to be forward thinking and keeping up with the times for 1, 2, 5, 10, 15, 20 years down the road. So it's really, really, really rough world to be in that world. So everybody says, I want to be a CEO, I want to be a CFO, and all that kind of stuff. There's a lot that goes into that. That's very stressful. Proxy. This is just kind of just an investing term. It's just a written statement. It's not really that important. Used to assign a stockholder's voting rights to another person, particularly one of the directors. So they get the board of directors together, and somebody can't be there in a meeting, and I'm going to have a proxy. I'm going to vote by proxy. Means somebody else is going to vote for me or for you. Net profit margin, simple kind of finance term. It's just basically the key measures of profitability that relates to firms. Net profits, its sales, shows the rate of return that the company, not the company is earning on its sales. The ROE, return on equity, it's kind of an important one. Measures that captures the firm's overall profitability. It's important because of the impact on the firm's growth, profits, and dividends. You want these return on equity to be high. It's shows another indication of strength, financial strength for the company. Earnings per share. That's just the return earned by each share. I think I have a ratio coming up here soon. Calculated by dividing all the earnings remaining after paying preferred dividends. This is a little too in the weeds and wonky. Really don't have to know that much about this for this type of class. But when you take more finance classes, you'll get into these kind of metrics a little bit more. Listen right here. PE ratio. That's an important one when you're looking to invest. It's the measure of the investor's confidence in a given security or a given stock or opportunity. Calculated by dividing the market share price by the earnings per share. Share price would be that would be the listed price that you find listed, the share price. Divide that by the earnings per share. How much those individual price stock are basically earning per share. Over 15 is good. Sometimes you see them into 25, 30. It's very good. but you want to see something that's at least, traditionally the average has been like for S&P companies about 13 to 15. What's a blue chip stock? Stocks basically issued by companies expected to provide an uninterrupted stream of dividends and profitability. If a blue chip stock would be like, a Coca-Cola, American Express. I mean, it's companies that you would definitely that you recognize. That those are kind of some of the blue chips act almost in a way as bonds do, in a sense, in that they're very stable over time. Disney is one that's been pretty stable over time. That that those are the ones. So you're going to have some stocks in your portfolio that are going to be your high risk stocks, and you're going to have some that are going to be lower risk stocks. They're not going to make a lot. They're going to be very consistent, so that they can kind of, if you have losses with your high risk, that will kind of counterbalance those. A growth stock, those are going to be your risky stocks. A stock whose earnings and or market price have increased over time at a rate well above average. So they're basically more risky, and they're on that upward trajectory. Then you have your income stocks. There's stocks whose appeal is that it's dividends, payouts. They're going to pay out. And these are stocks that offer dividend payments that can be expected to increase over time. Not all stocks have dividend payout options, but this is income stocks, the stocks that basically are pretty much will pay out over time. Speculative stock, that's more on the risk side too. It's a stock that is purchased on little more that the hopes its price will increase. So I guess that would be that along with the growth stock. This is more of a risky one, the speculative stock. And you can go into you can, if you need you can find brokers pretty easy online. And you can start investing on your own Robinhood. Then there's bigger accounts like the Charles Schwab, those kind of things. The Morgan Stanley type companies. Some of them won't even want to touch you if you don't have a certain amount of invested, but they should. I mean, some people starting off new, they should take whoever they can. And they will tell you from time to time, I want you to invest in this, that. I had a buddy who was a stock guy. He got his license. I worked with him at Nordstrom when I was tail end of college and out of college, and he wanted to be a stockbroker. He ended up being a stockbroker. And I invested money with him, and he was basically managing my portfolio. This is 20 years ago, and we went to Vegas one weekend, and I saw the way he was in Vegas and how out of control he was, and with a lot of things. And at that time, I'm like, I gotta get my money away from this guy. I can't trust him. This guy is reckless. I mean, on many levels. And another friend who was with us, who went with him too, was like, dude, Pat, he's a little out of control. I don't feel safe having my money with that guy. So those kind of things happen. I mean, it's good to know your investor or your broker, but sometimes be careful. You can see a side of them that you don't want to see. Okay, large cap stocks. These are just different categories of stocks. Stocks with a total market value of over $10 billion. That's easy to mark. Large cap. Mid cap, their value is between 10 and 2 and 10 billion dollars, and a small cap is a stock with total market value is less than $2 billion, which is actually pretty small when you think about it. Money. Now we're all going to try to get fun. We're going to try to get cute and try to outsmart things, but you just keep your money in the market and kind of know the trends. Rely on people who know more than you, but still try to, figure out the best way you can. But they say, I love this quote. The Nobel Prize winning financial economist says, money is like a bar of soap. The more you handle it, the less you'll have. And handling money too often brings high transaction costs and frequently results from overreacting to financial news. Just, buy and sell things, but don't get too cute. Don't get too cute, and realize, okay, if you have a stock that know when try to figure out or have an idea of when it's going to top out. And everybody's going to have stories. Everybody has stories of stocks that they held on for too long. Everybody has stories of stocks they sold too early. So it's just as long as you are disciplined and you have more wins than losses, you're going to be fine and get to that 10%. You're going to be good. Bonds. This is, we talked about bonds before. But bonds, basically, you are the lender of money to the issuer. They're not assets of the issuer, but they are a liability. It's basically a publicly traded IOU in a sense. So you lend money to something, and then it could be a corporate bond or it could be a municipality, and then they will pay you back, and they'll give you back more than you gave them. So you're gonna say, hey, I'm gonna give you, $1,000, and then I'm gonna get back, 4% more than that. So it's not a bad deal. Here's different types of bonds. The treasury bonds issued and backed by the U.S. government. Those are super, super safe. You get, but the payback on those right now is not that high. Mortgage-backed securities. This is a claim on cash flows generated by mortgage loans. These kind of mortgage-backed securities were one of the big reasons that we had in the 2008, 2009. The kind of the financial meltdown that almost destroyed the country. Because a lot of investments are tied to mortgage-backed securities. Municipal bonds. So I said, like municipalities. It could be a state. It could be a city. It could be a county. Bonds issued to a state or local government. Interest income is usually exempt from federal taxes, which is good. Which is really good to know. And a corporate bond. That's like a company. A company wanting to. So basically, here's what you have. You have top U.S. government. The second one is based on mortgages or housing. Municipal, state and local governments, and then corporate are corporations. So these are the main different types of bonds. That's it. Wow, I'm stunned. Hold on, let me stop sharing. Get back to my ugly mug. Yeah, so that's basically it for chapter 12. I will post. I'm getting really close to the camera. I will post this video. I don't really have any video. This slideshow. Don't really have any videos to attach to this, and some quizzes are coming up as well. So, any questions? Please get in touch with me, Jay Dussere at citrus.edu. Once again, JDUSSERRE at citrus.edu, or DUSSE at chapman.edu. All right. Take care. See you guys soon. Scram.